We go now to Robert Heller, a former Fed governor who served under the chairmanships of Paul Volcker and Alan Greenspan. He joins us now from San Rafael, California. Mr. Heller, welcome to Bloomberg News. Always good to have you on.
Good to see you, Mike.
Sir, I know you've only had a few minutes to kind of peruse what some of these headlines have been coming across, but what's your initial reaction here?
Well, actually, it was not a very eventful meeting. I think the minutes read almost exactly the same as the minutes of the previous meeting. Slightly less economic growth, a bit more caution in the real estate sector, and the disappointment about the unemployment rate. But the Fed has interest rates already effectively at zero at the short end, and nothing is going to change there. The big question, as you said before, is will there be further purchase of treasuries?
Right.
While I personally hope not, I think after the election, they will probably do some.
Mr. Heller, in about 20 seconds, and we will keep you after the break, by restarting an asset purchase program, is the Fed then admitting that it can't boost growth?
Well, it's very, very difficult for the Federal Reserve to boost growth. We have structural changes in the economy, and the Federal Reserve is really impotent to change these structural changes around. Also, there's the huge elephant of the big public debt and continuing deficit.
Right. And let's go right back now to former Fed Governor Robert Heller. He rejoins us from San Rafael, California. We also have another former Fed insider, David Resler. He used to work at the St. Louis Fed and is now chief economist at Nomura Securities and a Bloomberg Best. He joins us from the National Association of Business Economics annual meeting in Denver. Gentlemen, thank you so much for coming on. And Mr. Heller, let me start with you once again. We did notice in that statement the Fed saying it would be appropriate to provide additional monetary policy accommodation. What exactly does that mean, sir?
Well, I think it would mean that the Federal Reserve would engage again in large purchases of Treasury securities. And in that context, I think it's very important to note that the Federal Reserve has been conducting during the intermeeting period many test operations. They have been buying about $28 billion of Treasury securities, mostly as mortgage backs ran off. They've also been conducting term auctions just to keep their tools ready so that the markets will not be surprised if the Fed suddenly steps in.
David Resler out in Denver, is there a danger here that the Fed's planned asset purchase program could reduce liquidity?
Well, I think that's one of the things the Fed will have to be thinking about as they implement the next phase of quantitative easing. But I think that's at this point secondary in importance. I think the Fed's objective here is to lower inflation expectations, and that comes through loud and clear in these minutes. I think this is a pretty important release here from the Federal Reserve. And it seems to set the stage for the next round of quantitative easing.
And when might that next round occur?
Well, the minutes say soon, and I think soon means November 3rd.
A day after the election, no doubt. Mr. Heller, has the Fed turned the Taylor rule on its head? And I ask that because one of our senior economists, Joe Brusuelas, reminding us that the Taylor rule usually helps influence a central bank to raise or lower its policy rate. But because of that zero boundary now, the rule is now figuring into central bank asset purchases. Is that a fair assessment?
Well, I think John Taylor himself actually claims that the Federal Reserve should not be expanding monetary policy at the present time, according to his own rule, and he's probably the guy who knows it best. Different people make different adjustments to the rule, and so to suit their own purposes. But I think the Federal Reserve at the moment is really has low interest rates. We're almost in a liquidity trap situation. I think the great uncertainty in the other sectors of the economy, that's what's holding us back.
Mr. Resler, why are yields higher right now? Is there any confusion about what's going on?
Well, I think there's a little confusion about whether the conditions have been met yet to satisfy all members of the committee. In that quote that you just made at the start of this segment, you referred to what many members felt, but then there was the next statement said others felt that we need to see further deterioration before action was appropriate. So it's pretty clear that it's not a unanimous decision at this point, or it wasn't in September, a unanimous leaning toward further QE. So I think that may create some uncertainty in the market about whether they pulled the trigger, but I think the FOMC will pull the trigger at the next meeting.
Mr. Heller, any concerns about the size and the pace of any asset repurchase?
Yes, I'm very concerned about it. The Federal Reserve should not be just monetizing the federal debt. As you go down that path, it will become increasingly difficult to pull back the stimulus that you have into the system. When will it be appropriate then, instead of buying, to sell the treasuries, to shrink the Federal Reserve's balance sheet? And if you go down the road of accommodation, eventually you will get heavy inflation.
Right. Mr. Resler, we have about 30 seconds left. They talked about in the minutes targeting a path for the level of nominal GDP. How exactly do you do that?
Well, I think that the Fed would set an objective for levels and implied growth of nominal GDP over a period of time, and then strive to see policies that deliver that. I mean, that's a new discovery in these minutes. We'd heard other Fed officials in recent weeks talk about price level targeting and inflation targeting, and now we get a clear indication that they're also thinking about nominal GDP targeting. I think the important thing here, though, is that they see all of those as ways of augmenting and amplifying the signal that they get from whatever other policies they adopt in the form of QE.
All right. David Resler and Robert Heller joining us as the Fed's FOMC minutes from the September 21st session are released. Gentlemen, thank you so much for your expertise. We appreciate it.